Hey, good morning again, options traders. Well, another good question for the group, and this comes to me via email from one of the traders in our group, and he was asking, do short puts give you more ways to make money? And the reason this question came up, he actually forwarded me a PDF document from another trading firm showing the benefits of naked puts, and specifically out of the money naked puts. And the argument was that they give you three ways to make money, but if you buy the put, you only have one way to make money. And it's a rampant belief. There's so many people who believe that you have somehow this 3-to-1 advantage by being the seller. And that's why so many people want to sell naked puts thinking that they become the casino. Well, is it really true? Do short puts give you more ways to make money? Well, let's go find out. As always, before we do, please be sure to click like and subscribe. It is greatly appreciated and helps to promote the channel. All right, so let's take a look at an excerpt from this PDF. And I'm not going to show the name of the company or even the cover, but it definitely belongs in our idiotic ideas videos. So here's what he says. We will be selling put options, sell to open, not buying them, because it gives us a much higher probability trade. When you sell or write put option contracts, it allows you to profit from three outcomes, not just one. When you write a put option contract, you profit if the stock rises, stays stagnant, or even moves down slightly. So this is where the three ways to win comes from. If the stock rises, you're going to make money. If it sits absolutely still, you're going to make money. And even if it moves against you a little bit, you're going to make money. Seems like easy money. But this is just a really horrifically bad idea, and why so many traders think that it's free money, and why they all turn to selling puts to get rich quick. Here's why it's not going to work. Let's look at a long put option. So here is the risk graph for a long put. Let's say it's a 100 strike. We get our bend at 100. We can make money as the stock price falls. We've got these nice negative deltas going out in this direction. We have limited losses if the stock price rises. So if we buy the put, this is our risk graph. So let's say that the stock closes right here at 100, right at the strike. You're obviously going to lose money, the amount that you paid, which looks like $5 in this example. That's the maximum loss. If the stock price falls, so it's moving in your favor, but it doesn't fall far enough, maybe it just falls right down here to this break-even point, you're still going to lose. And obviously, if the stock price rises, because it is, after all, a put option, you're going to lose there. So there's the 1, 2, 3 ways to lose. But if you buy the put, you have only one way to win. And that is that the stock price must fall, but it must fall far enough and fast enough, in other words, beat the expiration date, in order for you to profit. So this is the false belief that they all say we've got three ways to lose on the long and only one way to win. Well, hey, let's flip it around. If the buyer can lose in three ways and win in only one, let's be the seller. And now we'll have three ways to win and only one way to lose. So it sounds like you've got this 3-to-1 advantage, and you're suddenly becoming the casino. That you're just going to rake in the profits because of this 3-to-1 advantage. All right, well, this is absolutely false. It is just an abuse of statistics. And what I want to do in this video is to just show you why, so that you don't fall into these traps. Let's start off with a payoff diagram. So here's a short put. Now remember what a payoff diagram is. This is where we're saying, what does the option actually pay off at expiration? So notice that if the stock is 100 or higher at expiration, the option pays off 0. You don't make any money from owning a put if the stock is above the strike. So there's 0 payoff if the stock is above the strike. On the other hand, what if the stock price falls below the strike? Well, now, let's say if it's at 99, that would have a payoff of -1. It would go against you by $1. If it falls to 98, it would be -2, and -3, and -4, and so on. We would get all of these negative potential payoffs all the way down to a stock price of 0, in which case the payoff is -100. You would owe $100 for shorting that put. So notice whenever you short an option, always remember that it's a liability. It's not an asset, it's a liability. You can't make any money if the stock price rises, but you could certainly lose money if it falls. All right, so this is where we get what's called an expected negative payoff. So if you just think of lining up a whole bunch of zeros out here for all of these different stock prices, and then -1, -2, and so on out here to the left, and you were to add them up and divide by however many numbers you have, you're going to come up with a negative number. There's no asset in that deal. There's no magical money. So now you might be thinking, all right, well, who in the world would want to sell that? And you're right, nobody would sell it for zero. And this is where, when we throw it out to the market, we let the traders hash it out, and we're going to come up with some type of a positive number. You'll say, all right, I'm not going to sell it for zero, but I might sell it for 1 or 2 or 3, and that just depends on supply and demand. How many buyers, how many sellers? So let's just say that we come up to a price of $5. So now you sell this option for $5. Now you do have some type of potential gains, but we still are faced with all of these potential negatives. So just to sweeten the deal a little bit, because this is really what he was saying in that PDF, let's assume that it's an out of the money put. And so let's say the stock is up here at 105. All right, so if the stock is at 105, but we have sold the 100 put, if the stock is anywhere above its current price, you're going to make money. If it's somewhere below, down to this break-even point, you're going to make money. And if the stock happens to be exactly at 105, where it is today, at expiration, you're going to make money. So there's your 3 ways to make money. And the only way you can lose money is if it's below this break-even point. So again, this is where traders think, oh, well, there's 3 ways to make money and only 1 way to lose. But remember, based on the previous slide, that the payoffs should be negative. But after we account for the price that you receive, it should have a 0 expected value. That's the whole idea of fair value. On the other hand, if the expected value is -$6, well, who's going to take $5 for that? In fact, that would be an advantage to the buyers. And so buyers will step in and push the price up to 6. So that's why we should always have a 0 expected value. That is just the pure definition of a fairly valued asset, whether we're talking about stocks, options, bonds, anything else. If the option is expected to lose 5, in this example, the market price will be 5. And so if you collect 5 and are expected to lose 5, there's really no expected gain in the long run. So this whole notion of saying, well, I've got 3 ways to win and 1 way to lose is so backwards, it's really hard to even show where the fallacy is coming from. But the main idea is that when people have this belief that you have 3 ways to win on a short option and only 1 way to lose, that they're not accounting for the weights. And so here's a real good example. Let's say that you are going to roll a pair of dice. We're going to have some type of a bet. And we're going to just add up the face-up sides, and we've got some type of a bet for whatever that sum happens to be. So let's start by looking at all of the possibilities that could occur. So here we've got die number 1. Here's the 6 spots on die number 1. Here are the 6 spots on die number 2. So these are all of the possible combinations that we could have. There are 36 of them. The smallest is 2 if we get a 1 and a 1. The highest is 12 if we get 6 and 6. And of course, we have other combinations in between. But if you notice on the diagonal that 7 is the most common sum you will get if you roll 2 dice. So it's right there. There are 6 ways to get a 7, 6 out of 36. 1 out of 6 times you're going to roll a total of 7. But let's say that I tell you that I'm going to offer this game to you, and I'm going to win if it's 7, but I'm going to be generous, and I'm going to let you win if it's 10, 11, or 12. And I claim that you have 3 ways to win, but I only have 1, because you get to win if it's 10, or 11, or 12. See, there's 3 ways that you have to win. I can only win if it's 7. There's only 1 way, so therefore you have the advantage. Well, now you can see the fallacy pretty clear. It's not accounting for the number of times that sevens come up, or 10, or 11, or 12. And that's exactly the mistake that's being made when traders say that you have three ways to win on a naked put and only one way to lose, trying to convince you that you have some type of a 3-to-1 edge in your favor. So if you ever hear anybody trying to convince you to sell naked puts because you've got some type of a three ways to win and only one way to lose, it's a trap. It's not going to make you money, it's going to make you broke. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.